participate. Adrian Mowat is with us, investor at Hong Kong SAR. Adrian, great to have you with us here. Thanks very much. So, you know, in the RBI meeting yesterday, we heard very clearly from the governor that maybe nothing imminent in terms of rate cuts or anything. So, in a way, markets realizing that they could be on hold for much longer than what everyone thought. In the US as well, that is the sense that some are starting to develop. That although we've heard from Fed officials themselves that, you know, rate cuts are going to come, etc., but the recent string of very strong data forces one to think that maybe it's going to be much later. Your thoughts, Adrian?
Yes, I think, remember, there's always been a bit of a disconnect in terms of the rate cuts implied by the futures market versus the dots that the Fed uses in their forecasts. So this idea of 3 rate cuts as the Fed official view has been in place for a while. Now, you know, moving on to the economic data, it has been incredibly strong, particularly the labor market data remains very robust. And so I think this is going to be a theme of 2024, that the market in terms of futures market, perhaps some of the bears on economic growth are overly optimistic on rate cuts. And that feeds through into other robust economies like the Indian economy. You know, your economy is strong. There's no need for the RBI to be reducing rates in order to stimulate economic activity. And I think if the story is one of a stronger dollar because the rate expectations in the market are having to be adjusted in favor of dollar yields versus other countries, then there's probably a message for the RBI that cutting rates may generate a slightly weaker rupee, and perhaps that's not what they want.
So what does one do from an investor standpoint? It's been a phenomenal year, right? The last 12 months for the Indian markets. You think we can replicate that in the next 12 months? And what's the best way to be positioned here in India?
I think it's very unlikely you're going to replicate the returns that were achieved in 2023. And there is an issue with the market, is it doesn't seem to be broadening. You know, you talked earlier in this segment about the Nifty Bank Index, where it's sort of testing its 200-day moving average. If you hadn't had the news with SBI potentially selling part of its stake in Yes Bank, we probably would have gone below that 200-day moving average. So you've got some strength in the PSU banks, but broad weakness in the very large private sector banks, large in terms of their index free float. In the budget was broadly a good budget, you know, forecasting a slightly more modest fiscal deficit. It all looked incredibly prudent, as it should do after such strong economic growth and good income from tax receipts, even though relatively poor receipts from divestments. So that doesn't really provide much stimulus. Yes, there's CapEx numbers look good, but I think that's also partly reflected in stocks like Larsen and Toubro, some of the cement stocks. So at the moment, I feel India is very much in a sort of consolidation phase. And we might be waiting until we get the end of the fiscal year results for the major Indian index names before you get a catalyst that gives you direction.
All right. Hi, Adrian. Good to see you. Adrian, Indian markets are looking up. Earnings are looking good. Political stability, everything's working for us. But we're trading at more than 20 times. China, if you want to call them a peer to us, they are available at less than half that valuation. Everything's good at a price, or China's not good at any price as of now?
Well, you know, you want to be in a market, in an economy where you've got strong nominal GDP growth, because ultimately that will decide the level of aggregate earnings and revenue growth. And the problem in China, you saw the CPI numbers again this month confirming deflation. You know, nominal GDP growth in China is less than it is in the United States and is significantly less than it is in India. So yes, there is value in China, and there are some opportunities, particularly where companies are returning cash to shareholders. But the broad market is a tough one because you just don't have that strong nominal growth that gives you the overall growth that you need in revenue and earnings to justify taking the emerging market risk.
All right, we leave it at that, Adrian. Thanks a lot for stopping by and speaking to us. Have a great weekend. We'll see you again soon.